This is the most important 48 hours in world money matters. Stop whatever you're doing right now. You need to know that what happens in Tokyo on February 9th will decide if your investments make it through the next 6 months. You have to see that the whole global money system, the stock market, the bond market, the housing market, the crypto market, everything is sitting on a very thin edge. And that thin edge is the Bank of Japan. On February 9th, the BOJ will share their policy choice. They will either keep printing money or they will raise interest rates. That one choice by some officials in a room in Tokyo will start a big chain of events that changes the world economy. This is not exaggeration. This is not scaring people. This is just how the numbers work. Because Japan is not like other countries. Japan is the keystone. Japan is the base that 40 years of easy money around the world was built on. If that base breaks, everything falls apart. Let me tell you why Japan is so big a deal. Why a country with an economy smaller than California's can crash the whole world money system. Japan has been fighting falling prices for 30 years. Since their big asset bubble popped in 1990, Japan has been in a bad loop where prices keep dropping, wages stay the same, and growth stays away. For 30 years, the Bank of Japan tried everything to stop it. They cut interest rates to zero. Then they made them negative. They printed tons of yen. They bought government bonds. They bought company bonds. They bought stocks. The Bank of Japan even became the biggest owner in Japan's stock market. They own ETFs. They own shares in big companies. A central bank acting like a big investment fund. All this to make prices go up. All this to stop falling prices. All this to get growth going again. And for 30 years, it didn't work. Falling prices kept going. Growth didn't show up. Japan stayed stuck. But things changed in the last 18 months. Prices started going up, but not from inside Japan growing strong. It came from outside problems. The energy crisis, supply chain messes, the big rise in global stuff prices, the weak yen making imports cost more. Suddenly, Japan has 3% inflation, 4%, the highest in 40 years. And Japanese people, who lived with steady or falling prices for decades, are freaking out because their wages aren't rising as fast. Their savings are losing value. Their way of life is getting harder. And they want action. They want the government to stop the price rises. This puts the Bank of Japan in a really tough spot. If they keep printing money, if they keep rates at zero, inflation will get worse. The yen will get even weaker. Imports will cost way more. Living costs will spin out of control. People will get angrier at the government. But if they stop printing, if they raise interest rates, they might bring back the falling prices they fought for 30 years. They crash stocks. They make the government go broke. They wreck the economy. Because Japan's whole money system is built on the idea that rates stay zero forever. When you change that idea, when you make rates normal, the numbers don't add up anymore. The debt becomes too much to handle. The whole fake setup falls apart. Let me show you the numbers. Japan's government debt is 240% of GDP. That's 10 trillion in debt on a 4 trillion economy. It's the highest debt to GDP of any big country in the world. Higher than Greece, higher than Italy, higher than any country not in a war or big chaos. The only reason Japan can pay this debt is because interest rates are zero. The government pays almost nothing in interest, but if rates go up, if they go from 0% to 1%, interest payments jump by hundreds of billions a year. If rates go to 2%, another hundreds of billions. At 3%, Japan spends $300 billion a year just on interest. That's more than defense, more than education, more than healthcare. The government would have to default or print way more money to pay it. And printing more creates more inflation, which pushes rates even higher. It's a bad loop that kills everything. This is not just a guess. It's happening now. Markets are already expecting rate hikes. Japanese government bond yields are going up. The 10-year JGB yield went from 0% to 0.8% in the last 6 months. That might sound small, but in Japan, where yields stayed at zero for decades, it's huge. And the shakes are spreading, because Japanese investors, the pension funds, insurance companies, banks, are seeing these higher JGB yields and thinking, why buy US treasuries at 4% when I can buy Japanese bonds at 0.8% with no currency risk? Why invest in US stocks when Japanese stocks are cheaper and the yen is getting stronger? Money is starting to come back home. This repatriation is starting. And that's really bad for US markets. Japan owns $1.2 trillion of US Treasury bonds. They are the biggest foreign owner of US debt. For 30 years, Japan took their trade extra money and bought US treasuries, financing the US deficit, keeping US rates low. But now that's turning around. Japanese investors are selling US treasuries, not in a big panic, but slowly and quietly. They are cutting back. When the biggest buyer turns into a seller, prices drop, yields go up, and higher yields mean higher borrowing costs for everyone. Higher mortgage rates, higher company debt costs, higher credit card rates. The whole US economy runs on cheap borrowing. And cheap borrowing needs foreign buyers, especially Japanese buyers, to pay for the debt. If Japan stops buying, if Japan starts selling, borrowing costs in America go up. When borrowing costs go up, asset prices go down, stocks fall, real estate falls, everything falls. But it gets even worse, way worse. Because the yen carry trade is not just about buying US treasuries. The carry trade is about using borrowed money. It's about borrowing yen at zero, changing it to dollars, and putting it in anything with higher returns. US stocks, emerging market bonds, real estate, crypto, venture capital, private equity. The yen carry trade has been the secret source of extra money for every risky investment in the world for the last 15 years. Every time there was a crisis, every time markets dropped, the carry trade came in. Japanese investors borrow cheap yen and buy the cheap stuff, giving support, keeping prices from falling too much. The carry trade was like the backup central bank for global risky stuff, but now it's coming apart. As Japanese rates go up, as the yen gets stronger, the carry trade stops making money. The numbers don't work anymore. If you borrowed yen at 0% and the yen gets 10% stronger, you lose 10% on the currency. Even if your investment went up, if you're using 10-to-1 borrowed money, that 10% currency loss wipes out all your money. You get a margin call, you have to close out, you sell US stocks, you sell crypto, you sell real estate, you buy yen to pay back the loan. When everyone does this at once, it creates a big wave of selling, a liquidation mess. Prices crash, margin calls get worse, more selling, lower prices, more margin calls. It feeds on itself. We're already seeing the start. The Nikkei stock market is down 8% in the last month. Japanese banks are showing losses on their foreign money positions. The spreads on yen debt are getting wider. The yen volatility is jumping. These are warning signs. These are the small shakes before the big one. And the big one is set for February 9th. On February 9th, the Bank of Japan will announce their policy choice. They will either keep rates where they are and keep buying bonds, which means they're more worried about falling prices than rising prices. Or they will raise rates even by just 0.25%, which means they're more worried about rising prices than growth. The market is waiting, traders are ready, computers are set up. Depending on what the BOJ says, trillions of dollars will move in seconds. If the BOJ keeps things the same, if they say they'll keep easy policy, the yen gets weaker, the carry trade gets more time. Risky stuff goes up, stocks up, crypto up, everything up, but only for a short time because the inflation problem doesn't go away. It gets worse, and pressure builds for a bigger hike later. But if the BOJ raises rates, if they say they're serious about stopping inflation, that they're okay with the risks to normalize policy, the yen jumps up, the carry trade falls apart, selling starts, US stocks crash, treasuries crash, crypto crashes, everything crashes because the extra money that held up prices for 15 years disappears fast. The Japanese money that went into world markets comes back like a huge wave. And here's the bad part. The BOJ is stuck. They have no good choice. If they don't raise rates, inflation gets faster. The yen falls hard. Imported energy and food get too expensive. Japanese people hurt. Political anger grows. Prime Minister Takaichi, who got elected to bring back Japan's good times, loses trust. Her government could fall, but if they do raise rates, if they normalize policy, they start the carry trade unwind. They crash world markets, they shake the money system, and they get blamed for a global mess. They lose either way. But there's another thing that makes February 9th even more important. The big change in Japan's economy structure. For decades, Japan used a model where companies were for employees, suppliers, customers, the community. Profits came second. Shareholders didn't matter much. Companies held huge cash piles. They didn't pay big dividends. They didn't buy back shares. They didn't focus on making shareholders rich. This made Japanese stocks do poorly for a long time. Japanese stocks traded at 10 times earnings while US stocks were at 20 times. Japanese companies had 5% return on equity, while US ones had 15%. Money was stuck. It wasn't used well. But that's changing. With pressure from activist investors, from the government, from new bosses, Japanese companies are moving to focus on shareholders first. They're raising dividends. They're buying back shares. They're selling off extra stuff. They're focusing on making profits. This makes Japanese stocks look good. Really good. For the first time in 30 years, foreign investors see value in Japan, see growth, see good returns. And if Japanese rates go up, if JGB yields look good, the mix of cheap stock prices and okay bond yields will pull money from the US back to Japan. It will reverse 40 years of money flowing out, and that reverse will crash US asset prices. So what happens on February 9th? Here are the possibilities. Scenario 1. The BOJ keeps rates and says they'll keep easy policy. The yen weakens. The carry trade keeps going. Risky stuff rallies, but inflation gets worse. Pressure builds for a bigger hike at the next meeting in April. This is just pushing the problem later. It's delaying what has to happen. The market will see through it. The rally won't last long. In weeks, maybe days. Selling starts again, as people realize the BOJ is just waiting. Scenario 2. The BOJ raises rates by 0.25%, but they say this is slow normalizing. They're watching data, they'll go careful. This is the middle way. The compromise. Market reaction will be mixed. Some selling at first as carry trade starts to unwind. But then things calm as traders see the BOJ won't wreck everything, that they'll handle normalizing slowly. This is probably the most likely one. It leads to weeks of up and down markets, no clear way, as everyone tries to guess how fast the BOJ will go and how much carry trade unwind that means. Scenario 3. The BOJ raises rates by 0.5% or more and says aggressive normalizing. This is the big bomb option. This is the BOJ saying, we're serious about inflation. We're okay with what happens. Market reaction will be terrible. The yen surges, carry trade blows up, margin calls everywhere, forced selling, flash crashes, trading stops, emergency meetings, emergency helplines turned on. This is like 2008. This is a global money crisis. While this is the least likely, it's not impossible. Because Takaichi is a reformer. She's a nationalist. She's okay with short pain for long gain. She might decide the only way to fix Japan is to end easy money fast. Normalize all at once. Forget the bad stuff. So how do you get ready? How do you set up for February 9th when you don't know which way it goes? First, cut risk. If you're deep in US stocks, especially tech, especially with borrowed money, cut back now. Take some gains, hold more cash. Don't wait until February 9th, because if scenario 3 hits, if the BOJ goes big, you won't have time to sell. The market will drop fast. Selling will be so quick, you can't get good prices. Cut risk now while you can. Second, spread out. Don't put all money in one thing. If you're all in stocks, you're open to carry trade unwind. If all in bonds, you're open to rising yields and Japanese selling. If all in crypto, you're open to money drying up. Spread it: stocks, bonds, cash, real estate, commodities, crypto, gold, and silver. Spreading is the only easy win in investing. When you don't know which way things break, spreading keeps you alive. Third, watch the yen. The yen is the first alarm. If the yen starts jumping before February 9th, if it goes from 125 to 120 to 115, that's the market expecting a rate hike. That's carry trade unwinding. That's your sign to get safe, cut risk, hold cash. But if the yen weakens, if it goes from 125 to 130, that's the market expecting easy policy to continue. That's your sign. Risky stuff might go higher. The yen tells you first. Watch it close. Fourth, think about Japanese stuff. If the BOJ normalizes, if rates rise, if yen strengthens, Japanese things look good. Japanese government bonds at 1% or 2% with a stronger yen is better safe return than US treasuries at 4% with a weaker dollar. Japanese stocks at 12 times earnings with better company rules is better value than US stocks at 22 times. If you think Japan means it on normalizing, if you think this change is real, put some money in Japan. Buy Japanese stocks. Get yen for the money coming home. Fifth, hold gold and silver. No matter what happens, no matter if the BOJ raises or holds, the end is the same. More printing, more weak money, more inflation. If the BOJ raises, they start a crisis. Central banks answer crises with printing. The Fed restarts QE. The ECB restarts QE. Money floods in. That money goes to hard stuff like gold and silver. But even if the BOJ holds and keeps printing, that's also good for gold and silver, because weak money keeps going, the race down keeps going, and gold and silver protect you. So the plan is clear. Cut stock risk, spread out, watch the yen, think about Japanese stuff, hold gold and silver, and get ready for big swings, really big swings. Because February 9th is not just another meeting. It's when Japan decides to keep the 30-year easy money test going, or stop it. Whether to fight inflation or falling prices, whether to save the global carry trade or let it die. That choice will hit every market, every type of investment, every person's money in the world. The Bank of Japan is the most important central bank right now. Not the Fed, not the ECB, the BOJ. Because they hold the base, they hold the carry trade, they hold the extra money. On February 9th, they decide what happens to the world money system. Watch this date, get ready for this date, set up for this date. Because what happens in Tokyo will decide what happens to your money. The countdown is on. Time is running.